all for joining us. It's been a little while since we've had one of these, so I'm super excited to get in front of everybody and be joined by some amazing co-hosts. But a couple of comments really quick. The market's an interesting market for sure. We've been watching what the expectations are over the next couple of years, and it was always, showing rates easing down, and now expectations are for rates to sort of stay in the 6% range approximately, really for the next couple of years. So what does that mean? That means we are in a purchase market for a while. We're seeing the purchase market open up a bit, but it also requires a lot of these tools for non-agency products to really be successful. Refi activity is going to continue to be opportunistic, and it's making it really important to have the right partners and tools to be successful in this part of the market, which is what we're here to talk to you all about today. So without further ado, let me introduce some of my co-hosts. First, I have Taylor Gosney, Director of Strategic Growth and Non-QM Education at SG Capital Partners. Taylor is a 25-year mortgage industry veteran. I've had the honor and privilege of working with Taylor for several years, and I have really enjoyed getting to iterate with you with what's going on in the market and work together with success with our customers, our common customers. But I know you are focused on driving growth through lender education and bridging the gap between product development and sales. So thank you and welcome to the webinar.
Thank you.
We're also joined by Nick Pabarcus, who's Managing Director of Non-QM at PennyMac. I've also gotten to work with Nick for several years, but really happy to be working it together again while you are here at PennyMac. Nick is a veteran of the mortgage banking industry, also for over 25 years. Before PennyMac, you were Chief Revenue Officer at Logan, and you are a CMB and accredited mortgage professional. And you also sponsor and you're an instructor at the MBA's School of Mortgage Banking. So another great insight, mortgage veteran that's joining us on the webinar. So thank you, Nick, for joining us.
Thank you. Thanks for having me.
And Raj needs no introduction. Raj is our SVP of Business Development and a regular on these webinars. So really excited to have you all joining us.
Thanks, Eloise.
So I thought I would kick off with, sorry, I missed our intro slide. Kick off with some industry stats. But I referenced in my opening comments that the MBA's forecast used to have rates coming down, and now they've actually got them going up in 27 and 28, and that's showing some of that market uncertainty. And that's also resulting in sort of flat projected volume expectations, a little bit of growth in purchase projected in 27. And I think that's, just a reflection of a shrinking refi market and people, deciding that, the purchase market will continue to grow. But I'd love to get some of your insights on sort of how do you see the market over the next year or two, and why is that important to the non-QM market? So Taylor, I'll just flip it to you first.
All right. Yeah, I mean, I think that I just saw an article, I think it was yesterday, on the amount of new business names, LLC structures coming in, right? People are starting to form their own businesses. They're starting to work for themselves. So I think just straight up from the self-employed, perspective, there's still very much a need and a growing need in that space. There will always be investors in real estate as well. So the DSCR market is growing. So I really see, I mean, I know that there's kind of a flattening and a leveling, but I think in the non-QM space, we're definitely seeing kind of an increase in the need. I mean, the standard guidelines and the standard way of qualifying people, it's just becoming harder and harder and harder with the way that the world is going. The self-employed and the real estate investors and people wanting to diversify their money instead of just having it sit in 401ks, there's just a bigger, broader need. So just straight from demand for that, that's where I see like the growth coming from. is really just from need.
Oh yeah, it's an amazing point that even though the market is sort of projected to be flat, the mix of what those products are really changing. And the liquidity, and Nick, you're going to be able to bring great insights into this because PennyMac is sort of a new entrant into this part of the market as well. And love to hear your thoughts on it. While the market is flat, having these products as part of your mix is a really, really important part of being, a participant in the market over the next few years. So Nick, love to get your insights sort of, globally on market trends.
No, absolutely. And, specifically kind of to your charting, Mike Frattantoni over at the NBA, no matter what room he's in, he's the smartest guy in the room for sure. But I think that, I think even he would say it's wrong. He just doesn't know where it'll be wrong. Right. And so while kind of the market is flat today, to your point, go back 90 days and had it going down over the next a couple of years. So I think what you can expect with all the geopolitical activity in kind of the space is really kind of a seesaw going up and down. And like as you pitch over into the chart on the right, you go back to January of 25, with rates a little bit above 7 and pop down into March, and you're in the 6 and 5/8 range. That's a big deal as far as affordability, right? And so I think that from an IMB or depository standpoint, keeping the muscular infrastructure of your organization to be able to take advantage of those small pops in kind of the market will be critical. And Taylor hit kind of the nail on the head. And, she's terribly smarter than I am. So I'm going to lean on her in this thing for a lot of the data. But kind of simply put, the demographics in the United States are changing, right? Like off of our numbers, and, kind of to your question, always like, the reason that PennyMac is in this game now, 36% of the US workforce is either self-employed or the gig income. We think that could be 50% by 2030, and that's a lot of growth there. The GSEs don't have a great solution for that borrower. And that's where I think that non-agency is coming in to be a stopgap for that borrower type that frankly has been left behind by the core agency products that are out in the marketplace.
Yeah, I was just reading an article on National Mortgage Professional yesterday. They published it. They said that 10% of the total lock volume that's coming in is non-QM, and 17.9% of all the total loans of the overall volume is non-QM, which is surprising, which is a big lift in that space. And I see that continuing to go up.
Yeah.
Yeah, and we're gonna get to some more of those. I do want to spend a second, and Nick, you started to talk about the interest rates, and I wanted to spend a second on this because I think there's some interesting phenomenons going on with the rates. And Nick, just as you said, if you go back to January, the far left side of the slides, the rates were higher. They were in sort of that. The agency rates were in the high 6s, but the green, just to refresh everybody, the gold bar is the LoanNEX index for all of what we'll call sort of the gold programs right down the center of the credit box. And the green line is DSCR products, again, sort of right down the center of that line. And then the silvery blue line up on the top is just opening that credit box up to higher LTV, lower FICO. And so, it's been interesting to track on sort of same parameters over time, where that spread between the products are and where the spread is to the agency paper. And I think what's interesting is if you go out a year ago, there was, obviously some things going on last April that created some volatility in the market, but it was generally easing down. But more importantly, the spreads were tightening. And what you're seeing there is more entrants coming into the market for all the reasons Nick just said, more entrants coming into the market, more liquidity in the market. That liquidity in the market is super important to everybody. You know, it lowers the spread, but it also creates opportunities for alternatives to a straight up agency deal or for a high val agency deal into a broader market. So you saw those spreads contract quite a bit, sort of, you know, towards the middle of last year. And then we saw them widen and we're seeing them contract again. So, you know, again, I'm going to flip between the two of you guys, or if somebody wants to open up, but love to hear what your thoughts are. We're in a little bit of a lot of noise in the market, but at the same time, there is a tightening of spreads between these products and the agency paper.
Well, yeah, I mean, to your point, on your chart in April of this year, you have your DSCR average at 6.5 with agency at 6 3/8. I mean, an eighth spread between a DSCR and a conforming fixed 30. You know, depending upon the scenario, depending upon the FICO score, depending upon the day, you can have an arbitrage in that even, right?
Yeah.
And so there are times that we've seen, especially in the full doc, and I have a couple of points to make a little later on in the presentation on this, but you know, you can see full doc non-QM underneath agency at times, you know, especially on your agency jumbo.
Absolutely. I mean, the pricing, sorry, go ahead.
No, Taylor, I was going to turn it over to you. So
okay. Yeah. I mean, I totally agree. I think the pricing models need to be very dynamic nowadays, right? They have to be responsive to the capital markets and the shifts that are happening there. You know, you mentioned liquidity. Liquidity is definitely returning. It is selective, but I think because of that selectiveness, that's where the spreads are we're starting to see them kind of tighten a little bit. We're starting to see, you know, that agency and non-agency, you know, even jumbo type products, you know, compared to non-QM, there's really not that big of a shift. And when you think about what you're getting for that extra eighth or quarter in a rate, to me, that's where I see the value, right? If you are an entrepreneur, if you are somebody who needs to utilize or wants to qualify for more, right, through a bank statement transaction, or be able to, you know, diversify your real estate portfolio, and you want to build based off of capacity and like what you can and can't do. I mean, I think the value in an eighth to a quarter in rate, it makes sense to me, right? If you're getting the product, you're getting what you need to do what you need to do, whether you're a business person, you're trying to buy a home, a second home investment, refinance your current property, you know, you need to look at what your options are. And, you know, if you're not in the space, you know, as Nick was saying with PennyMac, why they got into the non-QM space, because there is a need for it. There is a lift, there is a viable product and a viable borrower. And if you're not giving them all of their options, maybe agency is a good route for them to go for whatever their situation is, then by all means, but letting them know what their options are. Maybe it doesn't work for that transaction, but maybe the next one, they're like, you know what, I remember, you know, that lady told me that I have an option to just use my bank statements to qualify, or just have the property qualify for it versus my income. Things like that, where I really think, you know, spreads in pricing are important for sure. And right now, with there being such a small spread, this is the time to get in. I think the markets are starting to see the shift and the need, and so it just becomes a much more viable product option and opportunity.
Yeah. Well, and it's such an interesting time in the market too, Taylor. Like, you know, as you look at an agency LLPA grid, it passes through, right? And so, you know, if you're delivering a conforming fixed 30, you've got a standardized Fannie Freddie grid, and you push it through. SG Capital is a very responsible professional player, and I guarantee you're approaching it differently than we are as far as delinquency rates, as far as risk, other tolerances. You look at our LLPA grids, they're probably completely different, right? And so on every scenario, you probably have 65 different permutations of here's your FICO LTV a bucket. We're probably charging different for interest only. If it's a prepay, is it flat? Is it a declining? Is it an interest prepay? We have different values for that than SG probably does. And so it really is, for lack of a better term, a complicated maze as far as navigating the pricing until the delinquency trends kind of become standardized and the industry is looking at it in more of a similar fashion.
So thank you. And I'll leave this slide up in the background for just a second, but you just hit on something that's super important. And I'm very grateful for that, because a lot of people don't understand there's so much in the market that's really dynamic. Where Penny may be playing really aggressively in one part of the market, you may not be in another part. Where SG may say, this is my niche that I'm really comfortable with, may not be what your niche is. And that's why it's so important to not only have, a little self plug here, a great tool like LoanNEX, because we're going to give you all those answers, but it's also about having great partners and having enough partners that you've got the different parts of the market covered, because they change. Where you're leaning in may change, where you're pricing up may change, where you're comfortable doing something. Those all are incredibly variable, which is different than the agency side. So we're going to, keep talking about that, but that's a huge point. It's a huge point. And I'm going to lean into that with this slide as well, because what this is showing is the growth of that non-agency share. Part of that's because it's a purchase market. Part of it's because, as you said, 36% are self-employed. There's a great need in the purchase market to serve a broader base of borrowers, but there's also more products and it's more accessible. And if an originator can't see the products, they can't sell it, right? So we've been saying that for a long time. If they can't see it, they can't sell it. So we're here to make it easy to see. We're here to make sure you guys have access, but that growth is real. And when you look at the growth in the industry, a loan officer or an IMB or a depository, if they're not offering these products, they're offering a product to 85% of the market instead of 100%, so would you just cut yourself off from a lot of opportunity?
And if what Nick was saying earlier is true, that, the self-employed borrower is going to be up, in the 50% range by 2030, that's huge. I mean, that's already 33% of the market is bank statement loans. You know what I mean? And if what you're predicting is true, Nick, it would be foolish to not have these products in your quiver,
Yeah, I mean, as you throw in, Raj, like, your true self-employed, and Taylor, articulated, you can get the data on that, right? Your LLC filings, but your gig and your 1099, right? I mean, you've got, your other Uber drivers, you have your independent contractors. All of those areas are seeing tremendous growth as well. So when you take a bucket and you put it all together, it could be that high that quick for sure.
Mm-hmm. And really, I mean, I think that's attributed to, the quote unquote side hustles, right? Everything is more expensive. So people may have a full-time job and, they ride share on the weekends or in the evenings. Yeah. And, so I see a lot of that shift coming to that too, right? People doing kind of their, mom and pop thing on the side. Maybe they're doing Uber. There's other ways for people to kind of make that money. So we need to listen to that. We need to understand that. And as a market, as a mortgage company, who is lending paper and who, puts it out for securitizations and with the rating agencies and everything, like, it needs to be common conversation that we're having. And the more people that come into the space, the more that they understand the shift. I think that's where we all benefit from it, right? As Nick, you were saying, the pricing and the LLPAs and the shifts and what we value, maybe what is different than what but it's really about the capital strategy. That's what matters, right? Diversifying the funding sources. That's where the resilience comes in. So, PennyMac is a very large company. So they have different securitizations, different outlets. SG Capital, maybe a little bit nimble. So we have different needs and different fulfillments that we're doing. We manage, SMAs, and we do a lot of other things. So that's really, and Eloise, you mentioned it too. It's like this, we find value in all of it together, but there are times where the market is shifting. There are times where we see value in maybe a different option. Maybe it's a partnership we've got with another takeout. It just constantly changes. So staying on top of it, making sure you do have a couple of different options, not from just a product standpoint, but from a pricing standpoint. That's where LoanNEX is really helpful, right? It's going to break it down and show you, okay, here's for the same exact scenario, here's what you're going to get from a PennyMac. Here's what you're going to get from an SG Capital. What are the differences? Oh, if I change the FICO to this, we allow you to use the primary income earners FICO to qualify. So does that shift anything with my eligibility or my pricing? It's really just understanding the holistic need for it and then utilizing automation, LoanNEX, AUS, different tools to make sure that you're walking in the right direction for that particular transaction in that situation.
Well said.
Yeah. Okay. Sorry.
I'm sorry, please. If you wanted to go back to the other slide, I love this slide that you made. I love this one, but I wanted to underscore that your first bullet, your non-agency MBS share, 12% in Feb of 26. That's not counting your captive insurance of the bids, right?
Right.
So you're
Right.
12%. Yeah, you're 12% off of what we, we lick our finger, we put it into the wind. It could be as high as 20%. Captive insurance has had a frothy bid as far as your non-agency transactions out there. And like extrapolate that out into the different of the models that you see. So take TPO as an example. Depending upon who you ask, TPO is 20 to 25% of the total of the market currently. TPO executes higher in your non-agency. Depending upon who you ask, 35 to 40% of that pipeline could be non-agency, and of that, 25 to 30 could be a non-QM because there's so many more providers in that space. So agency MBS is certainly a big part of the story, but it doesn't cover all of the market for sure.
Well, and remember, this is share of outstanding securitization. So to see that share shift move up is what you're describing. That means there has to be so much more of that new issuance volume going in the MBS side, the non-agency side, to move that share that much. And it's been really interesting to watch, but it's I'm telling you, it's been wild watching how much growth. And that's what I think is super interesting about this slide. And this is a little bit startling because we would see little movements on the platform, and then all of a sudden March comes and it was like kaboom. That volume growth, these are unique loans priced on LoanNEX, so unique meaning if they're priced multiple times, it doesn't count multiple times. It's for every scenario, no matter how many times it's priced. And that was a huge amount of growth. And so what the right side of the page is showing, well, where did all that growth come from? And a lot of that was the refi side dropped because we already showed you guys the rates about how rates were going up in March. So it's really purchase driven. But it also was that full doc purchase, what we talked about at the very top of the call. So some of these are getting to be more efficient, better price than agency, and it's also giving some room for some of that jumbo or that high bow side of it. So you're seeing that average dollar size go up as well. But because there was so much volume increase, it doesn't mean the others shrunk. It just means that segment grew that much more in that month. It's the start of the buying season, but it was an unusual pop, I have to say, in the year. And I didn't know if you guys wanted to comment. There was a little bit of a widening on the LTV to over 10%. I'm sorry, LTV over 80 to 10%. It's not a huge change, but it was a little bit broadening of that. But it's also, these are also very strong credits where most of them are over a 720 FICO score, strong DTIs, things like that. But I don't know if either of you want to talk about sort of what you're seeing in the makeup of these loans over the first quarter of the year.
Yeah, we're definitely seeing that shift as well here. I think a lot of it, what it comes down to, and I've seen article after article on housing markets and really just paying attention to things, but affordability. I mean, even I recently saw one on HOA dues, right? HOA dues and condominiums, like with all the new condo regulations and everything that Fannie Mae came out with, and the reserves that condos are going to have to, hold now, and it affordability is coming to that. So the same $100,000 that you thought you saved, over the last 5 years for a down payment on a home, it's not quite the same $100,000 anymore. Prices of homes have kind of, I don't want to say stagnant, but they've ebbed and flowed. And so, people get into the market. I think affordability, I think, just the economy and the price of things. So the shift in an LTV is not surprising to me at all. And especially since we're not seeing a whole lot of refinances, right? Because people are typically in their lower rates. They want to stay in those. So they're not going to really do much with that equity unless they try to get a closed-end second or HELOCs, things like that. So I do think, separate topic, but that's another shift that I do see that's going to be happening, is we're going to see a lot more of that. We thought it was going to happen more in 2025, and I've seen definitely a bigger shift towards the, pulling equity out of the properties with a second lien. Definitely even in the first, few months here of 2026.
I agree, Taylor. I mean, the statistics show that there's $30 trillion of home equity.
Equity, yeah.
And 85% of the mortgages out there that are out there are under 5%. So you're right. Nobody's going to refinance their under 5%. I'm at 2.75. I'm never going to refinance my mortgage, right? But I have a ton of equity in my home, and a HELOC is a complete possibility for me. And I think as the market becomes more educated, you see it on the TV, the HELOC ads are out of control, on the TV and social media. So I think there's a concerted effort by people who are lenders who are offering, investors who are offering those type of programs to really get them out there, and we'll see growth in that. I mean, we've seen growth over the last couple of years, but I think there'll be even more growth in the coming years.
Yeah. This is a great place to talk about too. When you talk about the equity, there's so much of dominant investment property side of the market and what we see. Now, we over-index on those because people use LoanNEX. Those are harder loans to price in a traditional pricing engine. So we will over-index on those, but it's an enormous part of this market. And when you talk about the equity, that's where you see that cash out refis. People are taking that equity and they're, putting it into their next property. One of the things we love to try to encourage people to understand is make those connections, because those are repeat customers that aren't waiting for a refi to be a repeat customer. So they're really, really important relationships. But then getting to be known as an expert in delivering those solutions and a go-to for those solutions is, going to just give you that funnel to continue that business. So, I mean, Nick, I don't know if you want to talk about some of that investment property DSCR side, but this is really an interesting part of the market that is, I think, underserved across originators that people really need to, figure out how to dial in.
Absolutely. And, like as we take a look at the data there, it looks directionally correct with what we're seeing for sure. A little bit, the curious number was a little bit lower on the bank statements than what we normally see, and a little higher on the DSCR. Full doc something to talk about as we go for sure, because I think that there are some market dynamics happening there. But for folks that don't have access to the data, off the securitization numbers, your weighted average FICO on non-QM 740, 745-ish, weighted average LTV 70%, right? And that's the reason that it's so attractive on the MBS side, right? It is concerning at times to see LTVs creep up. I think that we're in a very acceptable range at 10%, but I don't think this will be an aha moment for anybody. And I say it simply because that's how I need to express it. Lower FICOs don't perform as well as high FICOs. High LTVs don't perform as well as low LTVs. I know, shocker. So you go ahead and put together a 660 FICO at a 90% off the securitization of the data ever 60, it's up to 20% a DQ there. And so if you see your book traveling up as far as that goes, there's acceptable risk because there's margin in that space. But if you see it trending high, that is a warning signal. And we'll certainly play in that space, but by no means do we want it to be the lion's share of our book, greater than 80. So we're going to be cautious about how we approach those riskier tranches for sure.
So Taylor, I'm going to switch it up a little because you spend a fair amount of time on the education side of educating people on these programs and getting comfortable with it. We've got a wide range of people on this call. So I'm going to ask you, like, where do people get timid? Where do the people feel like they need to learn more, or, help me talk through what not to be afraid of that you see people are often like, backing off on?
I think it's the unknown, right? So a lot of people think, oh my gosh, if it's not an AUS telling me what I need to, ask my borrower for from a documentation standpoint, then what will I ask them for? And realistically, when it comes down to it, if you compare it, I mean, simplicity. That's where people think non-QM is more complex. It's this, it's that, because you have to do a quote unquote manual underwrite for things and you have to look at trade lines. But really, when it comes to the core of qualifying from an income standpoint, it is the simplest form of income qualification, right? Bank statements, self-employed, just provide that. Don't give me K1s. Don't give me all 10. I don't need all of that. I just need your bank statements. And for a DSCR loan, all I need is a lease agreement or an appraisal that tells me what the home can rent for. It's literally as simple as that. You're providing assets. You were already going to do that on an agency loan. You're providing a credit report. You were already going to do that on an agency loan. So I think people have this misconception. There's myths out there that, oh my gosh, non-QM is just way more complicated. It's way more involved. It's really not. And there are a lot of resources. There are calculators, there's OCR technologies, there's Laminar, there's Prudence AI, there's all these different tools in the marketplace that help you do all of that for you, because it is that simple. It's as simple as just building something out, reading a bank statement, determining eligible deposits, dividing that over 12 months. It's very, very simple. Even looking at a W-2 or a pay stub, having to calculate it out, and did they have tips and this and that, it really can get very convoluted. I know full doc is definitely still a big part of our industry, people providing their full tax returns and everything like that. But I would caution them, or at least advise them, that you need to be looking at the other options, if not for you to get more business and have more conversations with realtors and things like that, but really to give the options to the borrower and let them have some sort of say in their journey. What is it that maybe something comes up when they're talking about it and you're like, they're DSCR loans, so that means, okay, I could get maybe 2 homes instead of having to pay all cash for this property. There's other ways that you can kind of, as they say, skin the cat, and I to the point of like self-employed borrowers want simplicity. Real estate investors prioritize scalability, right? They want to, how can they grow? What is the best way for them to grow? And there are 36% of the people that you will meet are self-employed at this point, and it's going to grow. How many people want to go into real estate, understand the importance of it? These are, instead of just saying, here's an agency, non-owner loan that I can do for you at this rate. You got to provide me all these things. I need, are you a landlord? Do you have a history of it? All that kind of stuff. You can just really simplify it with the product offerings with non-QM. It lives in the gray space, so it's built for not black and white. So every situation is different, especially when you're talking about an entrepreneur, a self-employed borrower, someone who needs to utilize a P&L or 1099. It really is about broadening what their options are and making sure that they understand what they are. As I mentioned before, agency could very well be the solution. It gets them the loan amount they need. It gets them everything they need. But if you could show them the difference in the buying power by being able to do a non-QM loan,
Yeah.
I think any smart, especially entrepreneur, right? They understand that, you have to kind of maybe sometimes spend money to make money. Maybe my rate's going to be a little bit higher, but what is this going to do for me in the future? That's really where, the education comes in, understanding what it is that you're offering to them. But really just don't be scared of non-QM. It's really not that difficult. It's actually, and I mean, I've been in this business for 25, actually more than that. And I lived and breathed agency, government guidelines. I knew them like the back of my hand. Non-QM is way simpler than that.
Yeah,
Yeah.
Taylor, it's funny that you say that. There are a lot of tools out there. And by no means is this webinar supposed to be a plug for LoanNEX. We want to educate the
A little plug every
industry,
now and then isn't going to hurt anybody.
but yeah, I was doing a demo for a big retail operation yesterday, and they had an LO move over from Loan Depot to their operation, and as soon as they wanted to have, they do about 5% of their volume as non-QM, and they want to ratchet that up. And so they came to us and they said, hey, this guy that came over from Loan Depot said that he used LoanNEX and he learned non-QM through LoanNEX. So we want to bring it into our organization and give it to our LOs. And I think you're right. There are tools out there that make this much simpler for people who may be timid to get into the space, and having the right pricing engine that kind of focuses in this area, that gives you all the information that you need right up front, can mini underwrite it in a way by going through the soft guideline elements in the eligibility or the price adjustment, is really key to kind of being confident in non-QM. These other tools are great. These bank statement analyzers are great. They're that they make things much simpler, but I think the entry point of getting into non-QM is having a pricing engine that understands it, So anyway, I agree with you.
And I want to make, Nick, I want to make sure, and I'm going to give you a chance to do this too. We have 2 questions, and I think, either of you guys this is all on topic, so it'll fit well. But they're trying to understand, for bank statement loans, what are qualified deposits and how do we calculate? So rather than like getting too into the details, it's, I think, more where to send people for those and how to think about it. And I don't know, Nick, if you want to take a shot at that first, or Taylor.
Yeah, there are bank statement analysis tools out there that Taylor had mentioned that are great automated tools. If you're doing it yourself, you would want to read your investor guidelines on what they will denote as a large deposit and what to go ahead and pull out of that calculation. But default into your lender or investor guides for sure. Most of them have a very good walkthrough of how to calculate the income. And then most of your TPO investors out there, and your correspondent investors will have some sort of a tool for you that will probably do the work for you. And that's where I think the technology aspect and AI is coming into play. We certainly have those tools. I know that SG does as well.
Absolutely. And really, when it comes to bank statements, remember, we're using the bank statements to tell us the structure of the company and what kind of income it can earn, right? We're stripping out everything that you would have to show on a tax return, which would be write-offs, expenses, things like that. So it's literally just business-related deposits. We can use them. As long as they're business-related, we use them.
I'm going to emphasize, I was just going to say, I'm going to emphasize how important it is to have these partnerships. Just as Nick and Taylor just said, they've got deal desks, they've got tools, they've got the resources. We're going to LoanNEX will make the guidelines available to you right there in the pricing table. So you've got your fingertip resource there. But these are great partners that are going to help you navigate through that through their tools. So I appreciate the question, and there are a lot of nuances. Everybody's got their different nuances, so it's really important to lean on those partnerships. I wanted to, because we're going to start running out of time shortly, so I wanted to flip a couple of things, and that is there's a lot of different, income doc types on the purchase side, and this is really where the meat of the market is. So the refi side is going to be, a lot of that cash out refi for investment properties and opportunistic refis, rate term refis on in general. But this is the meat of the market. And what we see is that full doc side on a primary purchase is still an important piece. It ebbs and flows with, how self-employeds are coming in, and those self-employeds are included in those alt docs. And the alt docs, have a lot of different flavors to them. But I thought we'd just take a second, since we've been talking about full doc and bank statement. Some of those alt docs, have to do with P&L, or they have to do with, different ways to qualify. So I don't know if you guys want to give some insights into some of those other ways that you look at income doc.
Yeah, absolutely. I think that that a comment I would make would be that we open the call with, there are times where there's an arbitrage between your non-QM, full doc, AUS jumbo, as an example. One of the trends that we're seeing is that your full doc CPRs, so your conditional prepayment rate, is higher. And so if folks are trading those particular pools or securitizing, if a high concentration of that is full doc, you won't get as premium of a price. And so what I think that a trend that you might see is, if those prepayment rates continue to be fast, meaning that they're prepaying too quickly, you could see full doc start to degrade a little bit on other rate sheets. How much, I think, will depend upon those particular speeds, but important to note that that all investors are using a model based upon an assumed CPR rate. If that's faster, then you're not going to get as premium of a price. If it's slower, you're going to get a better price, right? So
Yeah.
I think it's important to note that.
Well, there's also a lot of flavors of, asset qualification. And so
Absolutely.
that's, we get a lot of people coming to us too. And, there's a depreciation component to asset qualification. There's an income side to it. I don't know if you want to sort of demystify some of those kinds of opportunities for folks.
Yeah. On the asset side, you've got primarily two ways to qualify, and Taylor will be a much better sounding board than I will. But you've got your normal asset a depletion, which is, I've got this amount of money. I'm going to divide it by a number. Sometimes that's 5 years, sometimes that's 7 years. That's my income. And then you've got a residual of the income calculation, which is, this is how much money I have after I make all my payments. How much money do I have left over on that? So there are several different ways that you can qualify based upon the asset side, and that kind of fits into a general conversation around the borrower type. And as you guys were kind of talking about the education, Eloise, I know that you've got a ton of different shapes and sizes on this call, from owner operators to capital markets folks to frontline, the loan officers. If I'm a frontline loan officer overall, and I'm talking to a borrower, I'm putting them into four types. I've got a self-employed, which is our bank statement. I've got a real estate investor, which is our DSCR. I've got a high net worth, which is our asset qual. And then I've got a credit event, right? Which is, I've got a bankruptcy or foreclosure or a mortgage late. Like, as you're talking to that borrower thinking of non-QM, put them into those four types, and then from there cascade down through those particular products. But try and put them into one of those types, as you're qualifying the borrower, and it makes it much easier and sort of demystifies the process.
That's cool.
I definitely
That's
agree.
good advice.
And sorry, I was just going to add one more thing. So I definitely agree. Those are the exact categories that I would have put a borrower into as well. There's also options too that you don't want to necessarily pigeonhole them into each of those. Identify it, understand it for sure, 100%,
Yeah.
and kind of, but there are ways to stack the income as well. So you can have a self-employed borrower that's using big statements, but also use rental income, also use asset depletion, also like we can get the full picture of what they've got for an income, versus just like typically with agency type terms that okay, they're self-employed, we're going to need K1s, we're going to need all this kind of stuff. So just
yeah,
identify it, understand it, but also know that there are definitely options where you can utilize multiple forms of income for that borrower.
Yeah.
So this happens all the time with such amazing co-hosts as you guys, but the time has been flying by and we're getting towards the end. And I wanted to take a quick second to let you guys talk about a few things. First of all, there's this deck will be made available to everybody that is on the webinar. So you'll have all this information. It's going to include contact information for both PennyMac and for SG, Nick and Taylor specifically, and also the organizations. But I wanted to take a second because it's really important to not end this without saying, how do people get successful? We've been giving a lot of insights into how to navigate the different income doc types, why the market is moving around a little bit. But I just want to say, that what I have found over the years is you have to have access to the products and you have to be able to see the products right in front of you. And if you don't have access and if you can't see it, then you're not going to be able to sell these products. So your organization is going to lean on these partnerships to give you the products, but they're also going to give you these tools. So I'm just going to say leverage that technology with LoanNEX. If you don't have it, please ask for it. But also make sure that you've got sort of the field of options covered with the right kinds of products, but with also the right partners. So I'll let you guys talk a little bit about what it is to be successful, what's sort of the secret to success that you would, sort of, send down to folks. We've got just a few minutes, but love to hear your thoughts on how you see people successful in the market.
Absolutely. Having access to the product is number one. You've got to have access to it. If you don't, you're really doing a disservice to the borrower community, all of it, not just the self-employed and the real estate investors. Knowing the options, knowing what they are, being able to give those. Partnering with someone is ideal, right? Especially if it's something that you haven't done before. You want to partner with someone who's been doing it for a while, understands it, can help you through the process, walk you through all that stuff, understand it. The LoanNEX really just helps with that front end piece of it for you. So it's that. It's also having multiple outlets, right? Of course we would love for everybody to just use SG Capital, but really in the market, what you want is, healthy competition. If all of us, especially now for someone like PennyMac coming into the picture, that is great for this market, right? That means somebody who hasn't been in it before saw the value in it and is going towards that direction. We want that. We don't want to be the only person out there. That makes it harder. The liquidity becomes a bigger issue, getting into securitizations, things like that. So knowing that you've got a couple of key foundational partners is going to be huge in making sure that you are set up for success. Obviously, training, education, knowing all that kind of stuff, but really from an infrastructure standpoint, making sure that your systems are working together, making sure that every step of the way you've got something that helps you build the business rather than stop you from doing it, right? We know turn times are important. We know that kind of stuff. And as you build out margins for these types of products, you want to go with a lender and a partner that understands that has processes built to not stop or delay your process, but to keep things moving forward.
Yeah, I would piggyback on that as far as whether you're an originator or whether you're an owner operator or cap markets head, try not to attack the fringes, right? It's something where you need something sexy to sell out in the marketplace, right? Well, whether it be I-10 for national P&L loans, loan amounts up to 5 million, 5 to 10 unit properties. You combine all of those things together, and it's a really small part of the market. Remembering that weighted average FICOs are 745 and LTVs are at 70 means half of the loans are above that, half of the loans are below that, right? So be really good where most of the borrowers are, which is in that full doc bank statement DSCR spot, and then be comfortable navigating into those fringes. But if it becomes the primary part of your book, that can be challenging. So make sure that you're cognizant of that as you're building and creating that platform.
And I'm just going to say, and Raj and I do this all the time when we're talking with LOs and with capital markets desks that are trying to figure out how to get their LOs comfortable in this space. But you don't have to remember all of what PennyMac's criteria are and all of SG's criteria. That's what LoanNEX is there to do. We're going to help you navigate through all those things. I call it paint by numbers. There's so many different iterations and they change. So, just lean on those tools. And that's what allows your organization to sort of create that in-house expertise, is to lean on those partnerships, lean on and that technology. I just want to,
Eloise, I just want to add one more thing. One of our partners from Onity, Alicia Brisbane, said something really good in the comments. She said, agency has AUS and non-agency has deal desks. So there are tools that you can lean on, like LoanNEX, but you could also lean on your partner that has special, services that will help you understand the type of loan that you want to do. So lean on your partners. They have infrastructure to help you as an originator.
Yeah. And the most important thing is, again, if your loan officers can't see these products, they can't sell them. So, make sure to give access. We are at the end. I wanted to make sure this is going to be sent out. Everybody's contact information is in this deck. I can't thank you enough, Taylor and Nick, for coming on and joining us. This has been really, really insightful and helpful. We had a great audience participation in numbers. So this is also available for anybody that wasn't able to join. Pass it on to your colleagues. We'll give you the link so that they can access the webinar as well. But thank you all again very, very much, and I really appreciate it.
Thank you, everyone.
Thank you very much.
Thank you.